Hi, I'm Martin Pring. They say that a picture is worth 1,000 words, but I say that a chart is worth 1,000 pictures. And that's because charts in the financial markets often scream out very important messages that an important or significant trend reversal has taken place or is about to take place. Each month I publish a newsletter called the Intermarket Review, and each issue contains what I call the chart of the month. And that features a market that I think has just turned or is about to turn. So this series of videos aims at presenting these charts of the month. So if you're interested in them, please hit the subscribe button and you'll be brought up to speed on a regular basis. So without more ado, let's go to the chart room and see what's in store for this month.
This chart features a ratio between inflation-sensitive stocks, such as resources, and deflation-sensitive ones, such as utilities and financials. When the ratio is rising, it's the stock market's way of saying, we believe in inflation. At such times, commodities and bond yields usually rise. In 2008, the ratio rallied up to this horizontal level of resistance. Now, if it ever goes through, that would be super long-term bullish for inflation hedge assets. But that's another story. As you can see, for quite some time, inflation-sensitive stocks have been outperforming their deflation-sensitive counterparts. This month's data suggests that some kind of a deflationary reversal has begun. That's because the 12-month rate of change has peaked out from an extreme level. These arrows show that when this has happened in the past, the ratio has almost always experienced a bear market or an intermediate correction. Further evidence that a deflationary outcome is likely in the period ahead comes in this chart, which plots the weekly data. You can see that in late January, this ratio violated a significant uptrend line and violated the 65-week exponential moving average. That's the red dashed line. Now, if you cast your eyes back over the data, you can see that the EMA crossovers in the past have offered not perfect, but certainly reliable signals. Also, the short-term and intermediate momentum, having diverged negatively with the ratio for some time, have now crossed bearishly below their respective moving averages. Note that the intermediate series remains in an overbought condition, making the ratio vulnerable on the downside. Finally, the daily chart reflects a similar breakdown in the ratio. Underneath is my special K indicator, calculated by combining short, intermediate, and long-term momentum into one giant series. Trendline violations of this indicator, when combined with similar ones for the price, or in this case the ratio, reliably signal major trend reversals. Here's a bullish signal, and here is a bearish example. Now the ratio is already broken down, but as you can see, the special K is right at the edge. Usually when the ratio breaks before the momentum, the signal is stronger. That suggests that traders and investors should avoid inflation-sensitive stocks and other inflation-oriented assets in the period ahead. But it does not say that deflation-sensitive stocks will rise on an absolute basis, merely that they are likely to outperform their inflation-sensitive counterparts. If you enjoyed this chart of the month, you may want to go to Pring.com and download a free sample of our Intermarket Review, a monthly roundup of the world's principal financial markets with a special emphasis on the US. We also look at global indicators, bonds, precious metals, currencies, and international markets using ETFs to execute our strategies as much as possible. You'll find unique indicators and intermarket relationships you cannot find anywhere else. In the meantime, thanks for watching and good luck and good charting.